Domino Pizza announced a significant shake-up, including the closure of its Denmark business and between 65 and 70 underperforming corporate-owned stores.
Even the largest restaurant chains in America are not immune to the challenges posed by the ongoing economic slowdown. Domino's Pizza, operating nearly 19,000 stores worldwide, is facing a series of obstacles and financial losses. As a result, the chain is being forced to close thousands of underperforming locations. Join us as we delve into the troubles plaguing Domino's and explore how it may become a casualty of the great retail collapse. But before we continue, we kindly ask you to support our work with a thumbs up and don't forget to subscribe to our channel. 1. Domino's rise and fall. Over the past decade, Domino's Pizza experienced remarkable growth, expanding its store count from 10,255 locations in 2012 to 18,848 by the end of 2022. It even led U.S. pizza sales since 2017, with its stock hitting an all-time high of nearly $565 in 2021. However, things took a drastic turn in the fourth quarter of 2022 when the pizza chain reported disappointing earnings. Sales were dropping at a much faster rate than investors had anticipated. The company, which had been the leader in U.S. pizza sales since 2017, saw a rapid drop in sales that caught investors off guard. This decline was much steeper than anticipated, and raised concerns about the chain's ability to weather the economic slowdown. The drastic decline in share prices prompted Domino's to take action. Thousands of underperforming stores were slated for closures as the chain grappled with financial losses and sought to address its challenges head-on. The once thriving pizza giant found itself at a critical juncture, facing an uncertain future. 2. Share price plummet. In February 2023, Domino's share prices plummeted by a whopping 16%. Marking the largest price decline since 2010. Since then, share prices have continued to trend down, settling around $310 per share, about 39% lower than the same period a year ago. With this downward spiral, thousands of stores have begun to close, and Domino's has been forced to make tough decisions regarding the profitability of its operations. Since that point, Domino's share prices have continued to trend downwards, reaching a level of around $310 per share. This represents a substantial decrease of about 39% compared to the same period the previous year. The continuous downward trajectory of share prices has only added to the challenges faced by the company. As a direct consequence of this share price decline, Domino's has been compelled to take action by closing thousands of underperforming locations. The decision to shutter these stores is rooted in the company's need to address profitability concerns and mitigate further financial losses. Experts warn that if the company fails to rectify its problems swiftly, it could become overwhelmed by its mounting debt and potentially fall victim to the broader retail collapse that has been affecting various industries. 3. Pricing strategy backfires. It all started when Domino's, like many other U.S. restaurants, adjusted its prices to offset higher labor and commodity costs due to inflation. However, this pricing strategy backfired. Customers became dissatisfied with the higher prices, leading to a decline in sales across the country. Domino's targeted some of its most popular details with higher prices, such as the Mix and Match deal, which saw a price increase from $5.99 to $6.99. These changes, coupled with reductions in the carry-out deal, further aggravated customer dissatisfaction. Industry experts argue that Domino's pricing strategy was inefficient as it failed to consider changing consumer spending habits and the pricing strategies of its competitors. According to our report, Domino's prices remain 12% higher than pre-pandemic levels, which left many Americans dissatisfied. One of the major issues was that Domino's increased prices on some of its most popular deals. For example, the Mix and Match deal, previously priced at $5.99, saw an increase to $6.99 in December. The company also made changes to its carry-out deal, offering customers a pizza, dip, and bread combo or wings for $7.99. However, it reduced the number of wings from 10 to 8 and limited the deal to digital orders only, excluding those ordering in person or over the phone. 4. Delivery problems. Domino's delivery problems have also been weighing on its bottom line. The company has been experiencing a serious shortage of delivery drivers, with workers seeking better wages and working conditions elsewhere. Despite these labor market shifts, Domino's has been hesitant to partner with third-party delivery options, losing customers to rival companies. CEO Russell Weiner and CFO Sandy Brady acknowledged the significant pressure on the company's domestic delivery business, expecting these issues to intensify as the economy faces challenges. Despite the clear shift in the U.S. labor market, Domino's has been hesitant to partner with third-party delivery options like Grubhub or DoorDash. This reluctance has resulted in loss of customers to rival companies that offer more convenient delivery options. CEO Russell Weiner and CFO Sandy Brady have openly acknowledged the significant pressure on Domino's domestic delivery business. They anticipate these issues intensifying in the coming months, especially as inflation forces Americans to cut back on spending. More and more customers may start to question the value of delivery fees imposed by local stores and franchises, making the competition tougher for Domino's. In uncertain economic times, delivery becomes even more crucial for customers with lower disposable income, as they represent a significant portion of Domino's business. Weiner stressed the need for the company to maintain value and continually improve its service to compete effectively in a market where delivery choices abound. 5. International woes. Domino's troubles extend beyond the United States. In countries like Australia and Denmark, the brand has faced significant setbacks. Domino's Australia experienced a dive in profits, leading to a 24% cut in the dividend payout. In Denmark, the company decided to shutter all of its stores due to substantial losses. Additionally, in Italy, Domino's failed to capture the market, leading to bankruptcy and the suspension of operations for all its locations. In Italy, Domino's failed to capture the market's attention. When the brand entered the Italian market 7 years ago, home delivery was seen as a unique selling point compared to local pizzerias. However, the increased popularity of other food delivery services, such as Just Eat and Deliveroo, made Domino's delivery seem less attractive and necessary to consumers. These international challenges have taken a toll on Domino's market share. Over the past 6 months, the company significantly underperformed its rivals, including Pizza Hut and Papa John's. While competitors thrived with new menu offerings and partnerships with third-party delivery services, Domino's struggled to adapt to the changing market dynamics. This failure to capitalize on emerging trends has led to a decline in market share and further compounded the company's troubles. As we can see, Domino's struggles are not limited to the United States. International markets have presented unique challenges, ranging from cost of living crises to strong local competition. The inability to effectively navigate these obstacles has impacted Domino's profitability and market standing. 6. Rising debt and profitability concerns. The challenges facing Domino's have raised red flags for investors and analysts. The company's profitability concerns and increasing debt, which now stands at $5 billion against just $165 million in cash, are unsustainable. The company's stock buybacks have exceeded its free cash flow multiple times over the past decade. With rising interest rates amid a potential recession, Domino's will likely need to adopt a more conservative approach going forward. 7. Domino's struggles to adapt. Domino's has struggled to adapt to the current market, losing ground to competitors like Pizza Hut and Papa John's. Its unwillingness to embrace new strategies such as third-party delivery and marketing has cost the company valuable market share. In a fiercely competitive market, even the largest pizza chain in the world is not immune to the impact of recessions and downturns. As the U.S. retail apocalypse continues to claim struggling businesses, Domino's finds itself on the brink. With mounting debt, profitability concerns, and the inability to differentiate itself in a changing market, this could indeed be the beginning of the end of the company. Thank you for watching as we expose the challenges faced by Domino's Pizza. Don't forget to like this video and subscribe to our channel for more updates on the retail industry.